Hello, this is Kevin Stang with Deep Future Analytics, and I'd like to thank you for joining us today for our webinar, Are We in the Worst Point in the Credit Cycle? How should you respond? Today's presentation is a joint presentation from Prescient Models and Deep Future Analytics. I'd like to begin by introducing today's presenter, Dr. Joseph Breeden, CEO of Prescient Models and also Deep Future Analytics. Now, I'm a little biased, but Joe is arguably the best known name in the credit risk modeling industry. He literally wrote the book on loan modeling for the banking industry, as well as over 50 other trade publications in his name. His talents have been called upon across the world as he's created numerous financial models during numerous economic crises. Back home, he's been cited numerous times by the Fed Board, FASB, and other major publications, and in fact, he invented vintage modeling, which is FASB's recommended methodology for CECL. So without further ado, take it away, Joe.
All right. Thanks, Kevin. The talk today is about different cycles in lending. We talk a lot about economic cycles, but in fact, there are three distinct cycles that I worry about when we look at the health of loan portfolios. We have origination cycles, economic cycles, and credit cycles. And so to understand these, if we understand these cycles, we can anticipate future changes in the performance of our portfolio. So I'm going to go through each one of these in depth today. And as Kevin said, we'll have time for questions. But once I've talked about these cycles, we also want to focus on what do you do about it. It's not enough to know that things could be coming. We have to be able to take action in response. So beginning with origination cycles. Now, often the image here is someone riding high because often we think it's a good thing when we get bursts of loan demand, but this is not a constant. In fact, when we look at things, mortgage is always an easy example because there's so much public data on mortgage. But what you find if you look at origination volumes in mortgage, that's the blue line on this graph. The blue line, when you get booms in origination, it almost always corresponds to a drop in interest rates over an extended period of time. And by that, when we looked at this, the red line there is looking at the 2-year change in mortgage interest rates. So whenever that 2-year change is falling significantly, you see a rise in origination volumes. When the 2-year change is flat or rising, suddenly you get a dramatic drop in volumes. It's not too hard to understand that the demand for loans is sensitive to what's happening with interest rates. In fact, if you split this by refinance and new purchase, it's very interesting and no surprise. The top graph is showing the volume of refinances that happen relative to the change in interest rates. And I want to give you a chance to stare at this a minute because, of course, this is an anti-correlation. When rates are rising, origination volume falls on refis. When rates are falling, volume rises. And it's a pretty good correlation. There are some periods where there's a divergence that can be caused by other things. On that previous slide, if you were to go back and study that a bit, you'd see that around 2006, 2007, volume should have been dropping. In fact, it wasn't because the industry was pushing so hard to keep demand up. But I think you'd say the natural cycle for origination volume follows pretty well relative to interest rates. The bottom graph is showing new purchases. And here, the blue line, that new purchase line, obviously doesn't correlate very well to interest rates. In fact, what I've overlaid instead is unemployment. Just as a measure of health of the economy, there's a better correlation between general economic indicators and new home purchases. I think it's pretty easy to say that as consumers feel more wealthy, they're more likely to buy a home. Now, when you have a boom in origination, certain things happen in your portfolio. As a consequence of a boom, we get a portfolio that's full of younger loans, and younger loans are lower risk than older loans. And so what you see is that whenever I get a burst in originations, I have a short-term drop in my blended portfolio delinquency rate. But when that boom ends, then the portfolio starts to age and you'll get an increase in delinquency. And so as you look across here at each one of these booms in origination, there's an immediate drop and a corresponding rise in delinquency. It's not the only explanation for what happens. Obviously, there's an economic cycle in here too. But we know that it's easy to be fooled by, if you have dramatic portfolio growth, your blended delinquency rate looks low or your blended default rate. That does not mean that you booked good loans. It just means that you booked young loans, new loans, and that's what this graph is about. For most products, when we look at delinquency or default or charge-off life cycles, what the rate is versus the age of the loan, new loans tend to be very low charge-off rates. Now, in the first months, you can see a little spike up in the first month and then a drop. The magnitude of that first spike, that's first payment default. So it's either fraud or poor underwriting or whatever. That's totally portfolio specific. It's not necessarily going to happen to you, but it happens a lot. This is in fact based on industry data, so you can see industry-wide there has been plenty of first payment default. The point is that if you go through a period of dramatic volume growth and then you slow or stop, your portfolio ages, so the blended age rises and the blended delinquency rate goes up. Just something to keep in mind. It's the hangover effect from originating a large volume of new loans. Now, that's just the origination cycle. And obviously it ties to economics. But when we talk about economic cycles, I'm not talking about the indirect effect, such as through credit quality or through origination. I want to talk about economic cycles in terms of a direct effect, how it causes losses immediately. And a few things come out, obviously. So unemployment we talk about all the time. It's clearly the best correlation to delinquency. It's not a great predictor. It doesn't give you a lot of early warning. So you can run scenarios for unemployment, but it's hard to anticipate where that's headed. In fact, depending on your product type, unemployment may not always be a certain indicator. I'm showing intentionally mortgage delinquency on this graph compared to unemployment rate because in 2001 we had a recession. We had a rise in unemployment in 2001, 2002, 2003, but you did not really see a corresponding rise in mortgage defaults. You did see a rise in auto and other loan types, but for mortgage, the reason we didn't see it is that house prices were actually still rising during this time, so homeowners had the ability to refinance out of their debt potentially. In the next recession, that refinanceability was not there. So house prices can be an overlay against this, which they're not always perfectly correlated to unemployment. As we saw in 2001, they went in different directions. In 2009, they went the same direction. So if I look at house prices, here what I'm showing is the change in house prices. The blue line is the change in house prices. And of course, you can see the dramatic decline in house prices into the last recession and a corresponding rise in charge-off. Now, the charge-off I'm showing here is auto loan. We often get asked, is it not a problem to have a model that uses something like house prices if what you're predicting is auto loans or any other type of consumer loan? The thing is, a home is the largest asset for most consumers. If the value of that home is not rising, then the consumer can't refinance out of the debt. So the correlation to auto is just that their major asset is losing value, and they may have lost all the equity in that home, so they can't refinance. It doesn't work symmetrically. It's not necessarily the same going the other way. For example, I had a home equity line of credit on my home back in 2009, 2010, and the lender helpfully sent me a letter in the mail that said, because your home is worth less than it was when you took out your home equity line of credit, we've frozen the line of credit so that they could limit their risk. Now, I personally found that amusing that they basically told me my home's not worth what I paid for it. I did not run out in default the next day. We heard a lot about strategic default in the last recession, but if you looked at who those people were, they tended to be new mortgages, not necessarily lived in, or certainly not lived in very long. And so they weren't established. They didn't have equity built up, that sort of thing. For home loans that had been established, had built up equity, the amount of strategic default was extremely low from what we saw. So this issue of home value helps if you get delinquent. Whether it hurts or not has a lot to do with the nature of the loan that you're talking about. Household financial obligations ratio. I bring this one up. I'm not going to go through every economic factor out there, but I wanted to highlight these three because we always talk about unemployment rate. We talk about house prices. Both of those are in the DFAST scenario that the Fed provides. But if you look at the economic indicators coming out in the DFAST scenario, they mostly show things improving over the last couple of years. And yet we see things like credit card delinquency rates rising. The blue line here is consumer debt service payments, and the red line is delinquency rate on credit cards. So you can see credit card delinquency rates were dramatically high right after the last recession. They fell. They've started rising again. Unemployment's kept improving. House prices are rising. So why would this be increasing? Now, this is not a proof of causality, but the best correlation we've found is that consumer debt is rising. That blue line, it started to rise back around 2012. It's getting up to average levels looking back over the last 20 years already. So I think it's fair to assume consumer delinquency and default should rise as a consequence of that higher debt burden. And the truth is consumers have the ability to borrow loans. There are lots of ways for consumers to borrow money these days, lots of alternate channels and so forth. So liquidity for consumers is not a problem. I put in industrial production. Now, I made this slide a few weeks ago in preparation for this talk. At that time, the most recent information was this quote from the Fed saying U.S. manufacturing is in a recession, a manufacturing recession. We went out and looked at the actual data that that comment was based on, and I found it somewhat surprising that based on the most recent wiggles, we would call this a manufacturing recession. It's not very compelling from this, but I'm sure many of you will have seen in the news just in the last couple of days that the other indices of manufacturing activity are falling. So, in fact, we do know that the manufacturing is slowing, and that's usually an early warning indicator of future recession. So the things I've shown you so far don't say anything about whether a recession is coming. They're just more about what are the correlations and where are we. But if industrial production is down, that is a leading indicator of recession. Another thing that we've seen recently, of course, is that corporate earnings are declining, which is also another early warning indicator. We've seen quotes where people talk about an earnings recession having begun. But this is still isolated. Certainly across the entire economy, we wouldn't say that there's a recession yet. But when it comes to scenarios, everything we do is scenario driven. And I think it's fair to say that economists generally don't predict recessions. We always look to economists for scenarios. And I would ask an economist, if there's a recession next year, what would it look like? But if you go out and ask what economists actually predict, this slide is taken from Consensus Economics. It's a group that surveys a couple dozen, something on the order of 25 to 30 economists quarterly and asks what they think. As part of a CECL study that we did on procyclicality, we went back and purchased those scenarios. quarterly, as you can see, back to 2005, we wanted to know what the economists really said through the last recession. And what you'll see here is that this is unemployment, and back in '06, '07, '08, they consistently thought unemployment might rise by a quarter point or a half a point and then flatten out. By the beginning of 2008, they were beginning to recognize a trend and follow that trend, and all the way up to about the peak of the unemployment perspective on recession. They would follow a trend and then have things either flatten or decline a bit. After the peak, they generally said improvement, again following the trend and then flattening out. So the average economist, this is what this is. I don't want to say all economists are right or wrong, but the average of the economists that they would survey here is basically trend following for a year and then relaxing onto an average. Not necessarily through the cycle average, just a near-term average. So that's not exactly a forecast of recession. It's still useful to run scenarios. And again, in that pro-cyclicality study, one of our findings was that the CECL calculations are not terribly sensitive to which scenario you use. The difference in peak is a quarter or two. So, nothing particularly wrong with using this as a view of what could come, but it's not going to tell you necessarily how soon the next recession is. In fact, I want to point out there was an article I found interesting that was, again, I think this came out in The Economist, that recession forecasts are so bad they're good. It was reporting on some academic research that was done where they looked at how well economists had predicted recession. So the chart over here comes from this research predicting, looking at recessions from around the world over the last 30 years and saying how many of these did economists predict and with what lead time. The conclusion of all of this research was that if economists say that the economy is slowing, then we're probably already in a recession. By the time the economists say that we are in a recession, it already started a quarter or two ago, is generally the way that works out. So by that metric, sorry to say this, but by that metric, you'd say we're already in a recession because we've had plenty of people say the economy is slowing. I'm not sure that's provably true right now, but my view is if we're that worried about a recession, we should be looking at what to do about it. So that's what we'll get to next. Now, I want to finish with the third cycle here, the credit cycle. I personally think this doesn't get nearly enough attention. And I know one of the reasons it doesn't get attention is that it's hard to measure. Most people, when they talk about credit cycles, or if I talk about credit cycle, they will ask, how am I measuring this? Am I looking at FICO trends? The answer is absolutely not. FICO trends are a lagging indicator. They do not predict credit cycles. In fact, FICO scores today are really good because unemployment has been low for a long time. We're well past the last recession. So that 7-year window on bureau data, consumer performance looks very clean. A lot of the old delinquency and bankruptcy from the last recession is gone. People are paying their bills. They have money. So that doesn't predict whether there's adverse selection, whether the loans being booked today will have delinquency issues in the future. FICO scores, therefore, don't predict future delinquency. They're a measure of how much consumers have been able to pay their bills recently. Now, on an individual level, FICO scores certainly rank order people. I don't want to say they don't. But when you ask in aggregate how FICO scores are trending, all they're doing is basically correlating to unemployment and house prices and telling you how the economy's been doing recently. They're not predictive. So how do you measure the credit cycle? You need a model. There's no simple indicator you can look up on the FRED economic data repository to see what this is. So by saying I need a model, what I need is something that tells me what I expect given the current economic environment, given the loans that are being booked and their life cycle, and then measure credit quality relative to those expectations. So we always turn to a vintage model, age period cohort models. Kevin said that vintage models are the standard for CECL. The first draft of CECL really was written as if everybody would have a vintage model. And it's clear that vintage models are a good match to CECL, but they're not the only option. And people are doing many different things. But if you do use a vintage model, you can do something like this. So this is, again, looking at mortgage data as an example. And what we did was run a vintage decomposition into life cycle, credit quality, and environment, these three pieces. So the life cycles for mortgage are shown at the bottom. Super prime, prime, and subprime life cycles showing how they trend with time. You might ask, why do all these life cycles trend up? Well, these are conditional. If you've survived to 72 months in a mortgage, well, the best loans, the best consumers pay their mortgages off early. And so there's a selection effect through the age of the loan. That's why even for the best quality loans, risk rises with time. It's because the prepays come from the best loans. So with this as a benchmark for how an average loan would perform, then you also need to know, what does the environment look like? These lines shown in the upper right graph, there's one line here for every state. We measured the environment by state, and environment is partly the economy, mostly the economy, but you can see some spikes that jump out certain states. That's Hurricane Katrina. When you get hurricanes, when you get other natural disasters or there are various kinds of disasters that can occur, they'll show up as spikes in this analysis. We want to clean the signal for these things. So by the time I get to looking at credit quality, we segmented by FICO, but it's not dependent on FICO in any other way. We're simply showing that for different risk groups, what kind of trend do we get in credit quality with time? Now, we published an analysis last year, and I've given other talks on how you explain this variation. On a scale change in log odds of default, you see a period -1 back here in 2003. That's basically the defaults being, the probability of default being about half what the average would be. Being up here at 1 or 1.5, that's like the probability of default being 2 or 3 or 4 times normal. And so you can see there's a pretty wide range here on mortgage. Half of that's explainable by the changes in underwriting that the lenders make. The other half is consumer appetite. It really ties back to, do the good consumers want loans? And so when we take that measure of credit cycle and compare it to the Senior Loan Officer Opinion Survey and loan demand, we find really an astonishingly good correlation, that when demand is poor, credit quality is poor. When demand is high, credit quality is good. And so what you see is in 2003, 2002, the demand was high and the credit quality was good. But in 2004, 5, 6, especially 5, 6, 7, demand dropped and the credit quality was particularly poor. As soon as you got past the recession, and again, demand here, what we found is demand correlates very well to interest rates and house prices. So that early graph I showed on 2-year change in interest rates also correlates well to demand. So if we look at the current environment, lender standards, we can also measure from the Senior Loan Officer Opinion Survey. It's interesting to say that what you see is the period before a recession. I've marked in orange here. That's when the risky loans get booked, according to the previous graph. If you compared this graph on lender standards to the one I had on the previous slide, you'd find that in the last recession, 2006, 7, and 8 were the worst loans. But that's when lending standards were generally loose. It was only in 2007 that the lenders started to tighten standards. Once we got to the peak of the recession and afterwards, lenders were still tightening standards, but actually demand was coming back and the loan quality was very good. And so we had good quality loans all through this period. Now, most recently, it's interesting to ask what's happening. I didn't try to emphasize in these economic slides, but we almost had a recession in 2015, 2016. If you look at manufacturing, you look at change in unemployment, you look at a lot of things, it really looked like we were about to fall into a recession around 2016. But at that time, oil prices dropped, economic activity kicked up, a number of things came in right at that point that kind of pulled us back from the edge of recession. And so you can see in the lending standards that in 2016, 2017, there was a reaction by lenders to the poor quality vintage we saw in 2015 and the higher losses. So standards were tightened for a time, but then they loosened up again. And then most recently, what's been happening? Well, in 2019, for consumer loans, standards have been tightening on average, only a little. This is not dramatic, but at least not loosening. For commercial, they tightened in 2016, loosened in 2018, tightened again in the end of 2018, headed back toward loosening. So they've been oscillating a little bit there. But again, the underwriting standards we see here tend to be a reaction after the fact to what's been originated. They're not the primary driver of the quality being originated. That tends to come from loan demand. So I want to show you the most recent loan demand. Through 2018 and early 2019, demand had really started to drop. In mortgage, in other consumer types, and in commercial lending, CRE, you see demand falling over a period of a year or even more like 2 years in mortgage. In the most recent reporting quarter, as long-term interest rates came down, demand suddenly kicked up. So in mortgage in the last quarter, we saw a jump in refis. And what we generally see is that short-term kick in demand is usually good quality loans. The question is, where does it go from here? So it's too early, certainly from this mortgage data, to say, were the loans good that were booked in 2018 and early 2019? Given the usual patterns, they probably weren't great, because when demand is low, we tend to get poor quality loans. So in general, we would be worried about whether there was adverse selection, and we would be looking both in commercial and consumer lending. Are the loans from late 2018, early 2019 as good as what you had in previous years? My bet would be not quite as good. Most recently, the most recent quarter, maybe better. Anytime I try to predict that there might be a recession, the Fed is trying to prove me wrong. The reason demand is up here is because the Fed changed rates, long-term rates came down. All of that is going to have an effect on the likelihood of a recession and on the quality of loans. So I would say that there's no certainty of a recession coming, but generally we get the riskier loans before a recession. Now, in 2017, 2018, the quality was very poor. We're nothing close to that. And from a consumer demand perspective, demand is still much healthier than it was back during that period. So even though we booked the riskiest loans before the recession, the loans we booked were only mildly risky. Perhaps that means the next recession will only be a mild one. In fact, most indicators are that it would look more like a 2001 recession than a 2009 recession. So I do want to talk just a moment about CECL because, of course, it's interesting to think about adopting CECL right before a recession. Now, I know for many people on the call, that's been pushed out to 2023, but we do have clients, and I think some people who registered who have to adopt this year, and it's going to be a challenge at the end of the year if you think a recession could be coming and you have to switch from a backward-looking view to a forward-looking view. That could be quite a challenge. So this graph I pulled, some of you have seen before. I pulled it from our pro-cyclicality study where we looked at different model types and what the loss reserves would be at different points in the economic cycle. Now, I want to highlight that the black line here, actual loss reserves, this is complete forward-looking, the entire life of the loan. And so it's rising in 2006, 2007, 2008 because as an industry, we continued to book large volumes of risky loans, riskier than the past portfolio. So at this point, mortgage portfolios are replacing good old loans with risky new loans. So you really would have to be increasing your loss reserve rate all through this period. By mid-2008, the shock had taken hold and lenders stopped booking risky loans, especially when we're looking, this is based on Fannie Mae, Freddie Mac data. They weren't taking any risky loans at that point. So their blended loss reserve rate would start to come down as they booked only or accepted only the best loans and the risky loans start to burn off. Now that's not reality. We will never have a perfect forward-looking forecast. So I will talk about the ones in between, but let's also talk about the opposite extreme. This blue line down here is the weighted average remaining maturity. Now this is with a 5-year average, which is why that peaks way out here around 2012. Now 5 may sound like a long time, but you have to remember back in 2005, 2006, 2007, a lot of people were using 5-year moving averages of loss rates to set their loss reserves. So this is not unrealistic compared to what a lot of people were doing. These days, I think it's more likely that you'll see a 1-year or a 3-year type of moving average multiplied by the life of the loan. Still, it's going to be lagging. The warm method is one that you see presentations where people say that you can use that for CECL, but I don't know why you would. It doesn't predict it will only be lagging. It's easy to create, but it doesn't give you any of the benefits of CECL. Now, what are the benefits of CECL? I know a lot of people will say they can't see any. I just want to step through those slides for a minute and show you. It's hard when you look at that graph overall to really appreciate what it means to live this. So if in 2007, let's assume that between 2005 and January 2007, you had a forward-looking model that was showing increasing loss reserve requirements. The forward-looking models here are the vintage model, the survival model, a little bit on the state transition model because there was some rise in delinquency. Roll rates and time series, if it's not economics, they're not going to see it because they don't see life cycles and they don't see credit quality issues for new originations. So those models are flat. They give no warning. But you do get a warning from these other models, and I have to believe that if you saw such a dramatic increase in loss reserves over those 2 years, you would do something about it. At least that's my hope. Between January 2007 and January 2008, now all models start to trend up because the economy starts to deteriorate. If the economy is going down, almost any model should give us some indicator that we need to do something about that. Still, it's not too late to change. Even in the beginning of 2007, it wasn't too late to change. But if you go back and look at the origination volumes and the kinds of loans being booked, there was still a lot going on in 2007 that you wouldn't want to be doing. I'm trying to have us all relive this period because this is the pre-recession period. All the way up to January 2008, there's no official recession yet. And this is the time that risky loans are being booked and that you've got a chance to do something about the portfolio. So at this point, in between January 2008, January 2009, now we all know there is a recession coming. The economic scenarios start to capture this. In fact, I got ahead of myself on the previous slide. The roll rate and time series models still don't tick up until January 2008, so they're very lagging indicators. But more forward-looking models give you a lot of advanced warning. So the question would be, what does your model say? If you have a vintage model, what does it say about the credit quality you've been booking? How will that play out? It's not too soon to ask. Okay. And then that's what the whole cycle might look like. So in summary, where we are today is that unemployment looks good, house prices are fine, manufacturing is starting to suffer. There are other warning indicators economically. We have had mixed messages when it comes to loan demand. I would say we had warning indicators until this most recent quarter. The Fed took some action. So choppy waters when it comes to loan demand, which also suggests the credit cycle could be choppy waters. So it's really all about warning signs. And part of that is analyzing your own portfolio, looking at recent vintages for early warning indicators. When it comes to the economy, of course, you can look at yield curve inversions and loan demand. In fact, I want to point out the leading economic indicators, an index that's put out. If you look at how do they have what goes into their leading economic indicator, it's primarily purchases on big ticket items, homes, cars, durable goods. And since most of that is bought on loans, there's really no difference as the leading economic indicator is essentially a loan demand indicator. So it really comes down to how do we prepare. And this is the message I want to focus on, really, because the idea is that what we didn't do enough of in '07, even '06, is that we had warning signs. We were building models all through that time. It was possible to prepare, but the culture at that time was not one that was very conducive to preparation. I won't name names or companies here, but I'll tell you, I had a friend who was CRO of a major lender, and he knew that their credit quality was deteriorating and that losses were going to rise, and it wasn't a good time to book new loans. But he said, if I go to the board with that and say that we don't want to do anything, I'll get fired. And so there were plenty of warning indicators. I don't want to say they were ignored, but the culture was that you had to go along and keep booking because your peers were booking. You couldn't step out of the market. I think it's as lenders, you can't not lend. I accept that. But we really need to look at how we're lending, our underwriting standards, pricing, et cetera. So we're going to talk more about that. When the recession actually comes, I can be 100% certain that there will be a recession someday. So whenever that comes, there is a period where all you can do is try to survive. And we'll talk about what that means too. And if you get through on the other side, then you can prosper. And we have seen that those who survive do prosper in the period immediately after a recession. So that's where we want to get. So as far as preparation, it's about forward-looking forecasts, estimating what can happen. Again, a weighted average remaining maturity model might be acceptable for CECL, but it won't give you an early warning. If you want to prepare for what can happen, you actually need some models. Using those models, you can adjust pricing and mix. Now, I understand that there is a market price out there for loans, and you can't override that completely, but when you drill in by segment, you can ask, am I getting paid for the risk I'm taking on, and should I be shifting across segments, and do that in a scenario-based way. So preparation is going to be about looking at what would my yield be on new loans today given different scenarios for the economy, and even adverse selection on my underwriting. Am I getting the loans I think for the price that I'm getting? And how do we measure those impacts? Of course, that should come through in your loss reserves, but it should be right there in yield estimates. Now, as part of all this, we do need to measure sensitivity of the portfolio to economic drivers. That's why I started this talk with unemployment, house prices, consumer debt burden. Those things always matter. Every recession we've ever modeled, and I know people have heard me talk before, have heard that we made models through the Hong Kong SARS recession where it was caused by fear of disease. And you could correlate to number of people in hospitals, or you could correlate to unemployment and house prices. That in the end, it always comes down to the consumer balance sheet. And when we're talking about commercial lending, it always comes down to the same kinds of things, the commercial balance sheet. What are the key drivers that affect the health of those borrowers? So we want to build, this is the value proposition for stress testing. Yes, we do stress testing for regulatory compliance, but we really want to do it so that we know on the law side what risks are we taking on if there is a recession next year, factor that into the loan profitability for the new loans we take on, and am I getting paid for the risk? So the idea is that if you look across potential yield based on different segments, do this by scenario. Given today's environment, am I getting paid for the risk? Probably. But if we have a recession next year, am I getting paid for the risk? Well, maybe, depending on the segment. And you have to consider, I mean, to be honest, lending is an activity where you are betting on the economy every day. You're betting on what the future economy will be. So you want to know, how big a bet am I taking, and am I willing to take that risk? So I'm going to turn it over briefly to Kevin here, because he's taken some of this analysis that we typically do and done some hypothetical scenarios just to highlight what can happen here and what you can do about it. So Kevin, the floor is yours.
Thanks, Joe. And for the audience, this is probably going to be the easiest chart that you read today. Now, what I've done here is I've created just hypothetical scenarios, brought together 3 different mixes in my portfolio, A, B, and C. The overall goal in this exercise is to see if I were to change our strategy for new loans booked today, or buy and sell loan participations, all in an attempt to change the overall mix of our portfolio to something that we're more comfortable with. The bottom line is this. I'm sitting on mix A right now. That's the orange line. Joe told me there's a recession coming, and I believe him. So I need to change my overall mix. How do I do that? Well, I go to my model and I grab all of those inputs, including the custom economic scenarios, so I can forecast the real return on my loans through the crisis. Let's, of course, run this for our existing mix, the orange line, and then look a little bit more conservatively with the blue line, mix B, and then most conservative with mix C. Now, as a result of looking at forward indicators like our economic scenarios, along with what we normally use, such as FICO and term and LTV and some other inputs. But now when I take a look at the decisions that I'm making today and the loans that I'm booking and how I might want to restructure my portfolio, I'm not just looking at the past, but I'm looking at all the indicators that we saw today, in fact, that might show what could happen into the future based on the forecast, but also in the worst case scenario with the stress. And in the end, what that's telling me is if I just stick with mix A, the orange line here, and the forecast does hold, then I should have gone with that more conservative mix B. And if I had, off of my $100 million in loans, it would have been a lift of around $250,000. Now going with mix C might have been the same off of the forecast, but because we stress test as well and looked at the worst case scenarios, I can also see that mix C would have been a better option than just doing nothing and sticking with that orange line, mix A, that we're working with today. Now, if you're a well-capitalized institution, you might want to take on that risk and stick with mix A. The risk to your capital we can also compute, though, and in this case, it'll be 80 basis points given the forecast and 160 basis points given the stress test. I use simple math here. So based on that same $100 million in loans, that would be a $800,000 to $1.6 million hit to your earnings. And you would need to increase your allowance on the forecast by 80% and off the stress by 160%. Joe, I'm going to throw it back over to you now.
Okay. Obviously, changing the mix and monitoring credit quality is all about how you prepare for the possibility. Surviving a recession, well, you're going to live through the recession with the loans you booked. And so everyone says they always book the worst loans right before the recession. So do the best you can in that process. But once a recession comes, then it's about what are the things you do to survive. At that point, you can, of course, make underwriting changes and volume changes and so forth, but they won't have an immediate impact. The immediate impact will come in collections and in various other policies you have related to credit lines and so forth. Basically, it comes down to account management and financial management. In fact, I have a story from friends at a major lender where we were talking to them right before the last recession about what they were doing. And at that point, the recession was near. They were pretty confident there would be one. But they told us this story that they had been asked just prior to that how they could grow and stay competitive. And their answer was that they went off and did a research paper on how they could grow and get back to being top 10 in their lending category. They really wanted to, the CEO really wanted them to get back in the top tier. And after much thought, they distilled that article, that white paper, down to one page. After more thought, they distilled it down to one line, one word, which was survive. That their growth strategy was to survive the recession and grow afterward. And because of that, they did what most didn't. They actually cut back on originations in what they thought were risky categories back in 07 and 08 pretty dramatically. Compared to their peers, they dropped dramatically as in their origination volumes and portfolio size. When the recession came, it hurt them like everyone else, but they were a survivor, and they were one of the first to go back in 2010, 2011, and start booking large volumes. So surviving is what you do to get through to the other side. But on the other side, as we mentioned, that's when profitable lending, the most profitable lending, happens after the recession. So I probably don't have to dwell on that. I think that's fairly obvious. If anything, sometimes people wait too long to go back in after a recession because I think it's the profit models that they're running. They're looking backward at historic loss rates, overestimating the risks they're taking on, and so underestimating the yield. And in fact, after the recession is an opportunity to make sure that your profit modeling, your loss forecasting that goes into that is forward-looking, given where you are in the economic cycle and the actual credit quality available. So that's our talk today. Before I open for questions, I'll just point out that for those interested in CECL, we've been doing a bunch of benchmarking. We run a shared data pool across hundreds of clients, and we've been looking at that to get an idea of the shift that's going to happen in loss reserves between CECL and FAS 5 and what it looks like when you compare across different product categories. We're compiling all that right now, and October 17th, we'll give a webinar with those results. So I hope you can join us for that. Thank you all for attending. Yeah. We appreciate your time today. Kevin, I'll let you have last words.
Thank you all as well. Our contact information is below. We'd love to answer any other questions that you may have, and we also love the opportunity to work with you. So please give us a call or